Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In today's video, I want to talk about the Fed's 50 basis point or 0.5% rate cut. I know I'm about a week late on this. The reason for that is I just got back from overseas. I was there for about 3 weeks with my family. I'm a little bit jet lagged, but I'm ready to take this on. So let's get right into it. So the Fed cuts rates by 0.5% or 50 basis points and how this affects you. So first and foremost, we need to understand what are rate cuts. Okay, so we talk about this a lot. I've talked about this on the channel for years now, but if you don't even understand what this is, then the whole video is kind of gonna go over your head. So what are rate cuts? So the lowering of the federal funds effective rate is what that means when it says we are cutting rates. So what is the Fed funds rate? So this is the rate banks charge each other when lending money overnight to meet the Federal Reserve requirement. So think of it like, hey, the banks are in business to lend you money. They're getting their money lent to them at a certain rate, so they need to charge above and beyond that to make a profit. So if they get their money at, let's say, 5%, they're going to give it to you at a higher rate so they can make money on that difference. That's how banking works. So this rate influences other interest rates. So as I mentioned, this could be, car loans, mortgages, could be investing for research and development for businesses. It could be small business loans. It could be a bunch of different things. But just think of it as the lever that kind of controls the economy. And we'll get into that in this slide, the next slide. But I do want to tell you what this means right here, this 4.83%. So this is just a chart of the federal funds effective rate. You can see right now we're at 4.83% after these rate cuts. Just before that, we were just above 5. We're at 5.33. So they did come down about 0.5%. So why does the Fed even raise or lower rates to begin with? So if we look at the left side here with lowering the rates, this is to stimulate economic growth. The reason for that is because the cost of borrowing capital is cheaper. So when rates are low, think of borrowing being high and vice versa. It's to prevent rising unemployment. So companies are able to take out more debt and staff more people. Also, it makes borrowing money cheaper. So if you remember, sometimes cars, you can get cars for 0% loan, right, for 60 months, some sort of introductory rate, right? Think of mortgage rates, think of car loans, think of business loans, think of lines of credit. It makes everything cheaper. And then finally, it encourages spending and investing. So when rates are low, you want to invest, you want to spend money, you want to take out debt, you want to make decisions that are a little bit more short-term when rates are lower because you know that the cost of that capital is not going to be as high. When you look at increasing rates, why do they do that? It's to kind of cool things down, okay? So when money is very expensive to borrow, people are going to think twice about taking out a loan or making that purchase if they can't afford it in cash. It's also to combat inflation. So we had serious inflation since basically 2020. It's starting to come down year over year more and more. However, it's still, the baseline is still high, right? Prices from 4 years ago are significantly lower than what they are now. It makes borrowing more expensive. So think of yourself as like a business or an individual. Do I really want to take out that loan? And then also it encourages savings. So when rates are high, why would someone want to invest in the stock market or invest in some risk asset when they know they can get a pretty high baseline, almost risk-free, whether it's in T-bills or a savings account, for example? Okay, so this is the reason why you're watching the video. So you want to know, hey, what should I do with my money? What does this mean? How do I invest, right? So we're going to talk about this, a couple different examples, and we're also going to talk about the other side of things when it comes to rate cuts. So let's talk about asset classes that have performed depending on when that rate cut has occurred. So what does that mean? So if you look at the blue, that means the results during a soft landing. If you look at the gray, that means the results during a hard landing. So this is from 1984 to now, and this is created by JP Morgan. I just took a screenshot and put it in the slide deck. So these are the average 12-month returns after the first Fed cut monthly, grouped by soft or hard landing. So you can see here U.S. growth equities, basically stocks, U.S. large cap equities, stocks, international stocks, U.S. value, U.S. small cap, and then right in the middle here we have commodities, and then U.S. core bonds, 2-year treasuries, 10-year treasuries, U.S. high yield, cash, and then the dollar. So you can see here, whenever it's a soft landing, most of these risk-on assets tend to do well. Actually, most of these assets tend to do well. But when you look at a hard landing, that's kind of a different story. So risk assets and soft landings, these are typically large cap stocks. These are high yield bonds. They've done well when the rates cutting cycles have coincided with a soft landing. We've been hearing about soft landing, soft landing, soft landing. Is that the case? I have no idea, right? But when it's a hard landing, you can see when rate cuts coincide with recessions, which we'll talk about in the second half of this video, risk assets have suffered, right? So if you look at like something like international equities, when it's a soft landing, they've returned 16.3%, right? When it's a hard landing, it's negative 14.3. It's actually the worst on this list. So I'm not going to go through every single one of these, but all you need to know is that U.S. growth equities seem to have the highest risk and reward when rates get cut. These are things like the S&P 500, which I'll show you right here. So if you look at the S&P 500, say you're not interested in all those other asset classes and say you're just focused on something like an S&P 500 index fund, you can see here that basically the S&P 500 returns 4.9% on average 1 year after the first interest rate cut. So this is typically 70% of the time is you're going to see that positive correlation. So if you look at 3 months after the first rate cut, it's basically 50-50, half green, half red. If you look at 6 months after the first rate cut, it's a little bit more green. And then if you look at 1 year after the first rate cut, you can see it's an average of 4.9% compared to all these different economic times. If you look at a little bit longer scale, this is one of my favorite charts. Basically, this is the Fed funds rate versus the S&P 500. So the blue line is the performance of the S&P 500. So you can see 25th of September, 2024. That's where we're sitting at right now. But if you look at the Fed funds rate, the higher this rate is when money is more expensive, quote unquote, to borrow. Remember, we talked about this in the first slide. You can see that the performance of these asset classes is okay, right? But as soon as we hit something like 2000 dot-com bubble and we start to get to lower interest rates, that's when the S&P 500 starts to tick up and up to record highs, right? And then we have 07, 08. We cut interest rates for basically, 7-8 years to ZERP, and then we keep cutting them, and this is basically what you get, right? 2020 was the cerveza sickness, whatever you want to call it. We hit ZERP, and then risk assets, obviously exploded again. So let's touch more on that. I want to tell you the other side on this, but when it comes to recessions and rate cuts and things like that, there's a lot of very compelling evidence. So stick around to the end of the video. But before that, here's a word from today's sponsor, Policy Genius. Life insurance is my family's financial safety net. Did you know that 40% of people with life insurance wish they had purchased their policies at a younger age, or that nearly half of American adults, 46%, expect that if they died today, their loved ones would inherit their debt? This is why my family chose our life insurance plan using Policy Genius. Getting started with Policy Genius is simple. We filled out our information on the website. We talked to one of their award-winning licensed agents. They walked us through the process step by step and got back to us with quotes that made a lot of sense to us financially and covered our needs. Policy Genius knows how valuable your time is. Their technology makes it easy to compare life insurance quotes from America's top insurers in just a few clicks to find your lowest price. 80% of Americans overestimate the cost of life insurance. With Policy Genius, you can find life insurance policies that start at just $292 per year for $1 million of coverage. Some options are 100% online and let you avoid unnecessary medical exams. Their licensed award-winning agents can help you find the best fit for your needs. They work for you, not the insurance companies. That means they are not incentivized to recommend one insurer over another, so you can trust their guidance. Policy Genius is for parents, caregivers, and anyone else who has people who depend on them. They simplify the process of getting life insurance so you can protect the people you love. Although some of you have life insurance through your employer, you may not be as well covered as you think. Your family deserves peace of mind. A life insurance policy through Policy Genius can give it to them. Check life insurance off your to-do list in no time with Policy Genius. Head to policygenius.com/whiteboardfinance or click the link in the description to compare free life insurance quotes from top companies and see how much you could save. Okay, so let's get into one of my tweets here from August 2nd, 2024. And I actually have some other tweets from like way earlier in the year from February talking about these rate cuts because they're inevitable, you guys. We're not going to keep raising rates forever, even though people think it's necessary. It's just not the way the game is played, okay? So I tweeted here August 2nd, 2024, rate cuts usually precede a recession. So what I did was I just went in here and looked at the blue line. This is the Fed funds rate. Remember, this is the thing that's being cut right now. That's the point of making this video. And you can see whenever it gets cut precipitously multiple times, we enter a recession. That's what these gray bars are. These gray bars are recession. So we had the early 90s, we had the dot-com bubble, we had 07, 08, we had cerveza sickness, and then now we're back up to basically this was at 5.33% at the Fed funds rate. So if you look at this, it gets cut, enter a recession, it gets cut, enter a recession, it gets cut, we enter a recession, it gets cut, we enter a recession, so on and so forth. So basically, this is what we're looking at right here, and we're actually starting to cut literally where my cursor is. And then also, this is from Nick Gurley. He also has this tweet, which I thought was pretty interesting. So 10 of the last 14 Fed rate cut cycles directly led to a recession. So the only times they didn't were in 1966, which you can see right here, 1984, 1995, and 1998, when the economy was noticeably stronger than it is today. So if you take a look at this mixed with this chart right here, what are your thoughts? I mean, with the yield curve just uninverted, so I can make a whole new video about that, but based on all this stuff going on right now, I don't know, it looks a lot like what's happened in the past. Let me know your comments down below. So with all that being said, you can pause the video here to take a look at this historical Fed rate cut cycles, but before that, check out Whiteboard Finance University if you haven't already. There's a 20% off discount code. Check out the link in the description below, and then also my thoughts. So it's been a while. I was on vacation for about 2.5, 3 weeks. Just got back. This was happening while I was on vacation. My portfolio dropped pretty significantly while I was on vacation, and then now it's back up to pretty much all-time highs as the S&P 500 is hitting new all-time highs. So typically what I think is, if you want to look at my macro thesis on all that, on all this, is the U.S. dollar dominance is still so strong that, no matter what we do, if we cut rates, inflation is probably going to go back up. That's typically what happens. Then we're going to raise rates to battle inflation, so on and so forth, yada, yada, yada. It's a never-ending cycle. I have a million tweets on this over the years. So just think of the Fed funds rate as a lever, right? It's almost inverse to whatever the market does. So high rates, risk off, low rates, risk on, that kind of a thing. What I'm doing personally is that I can tell you in the sidelines where I've had most of my cash, one of my high-yield savings accounts just went from 5% to 4.5%, where I have a pretty significant amount of cash sitting in there in the sidelines. That's for other investments like commercial real estate and things like that. That forces me to look at the hurdle rate. So what is the hurdle rate? Hurdle rate is just something where I need to beat as an investor to make it worth my while to invest. So if I know I can get 5% essentially risk-free in a high-yield savings account, why would I put my money at risk for something that's earning me 6.5%, 7%, right? When I know 100% I'm getting 5, 70% I'm getting 7, right? So that hurdle rate needs to be much higher for me to part my money from that guaranteed thing. But once rates get cut low enough to where inflation, you're basically at inflation, if not losing money to inflation, then it makes no sense to be in cash, which is why you want to be risk on, right? You want to be back in the market. You want to invest in, Bitcoin, stocks, real estate, whatever you want to invest into, right? Collectibles. I don't know what your cup of tea is, but basically I look at everything as a hurdle rate, and am I being compensated for the amount of risk I'm taking on, right? So that's the problem when you get into a zero interest rate policy environment, is that you're not earning anything in your savings account. Savers are losers, right? So where's your money going to have to go? For most people, it's in stocks, right? Or it's in real estate. So just something to think about. Right now, I'm still going to sit in a little bit of cash, but I do want to see what happens with inflation. And then also the election is going on and stuff as well. So I don't have a crystal ball, but I'll tell you right now, I'd say about a third of my net worth is in real estate, a third of it is in equities, 15 to 20% is in Bitcoin, and then the rest is either in cash, collectibles, precious metals, things like that. So hopefully you got value out of this video. It's good to be back. Please share the video with a friend, and as always, have a prosperous day.